Hello, everyone. Clint here, research analyst for the Bauman Letter. And today I'm joined by Ted Bauman, editor of the Bauman Letter. And today we have the next edition of Your Money Matters. So what I thought we would talk about today with Ted is the state of the IPO market. So the IPO market is making headlines once again with the recent offering this week of Casper Sleep, which is the mattress retailer, mattress in a box company. It just went public, but they've had some issues. They've had to reduce the price range at which they went public. So they originally intended to go public around $17 to $19 a share. They had to slash that to $12 to $13 a share. And today, as I looked right before this, they're trading right around the low end of that range. So we continue to see IPO valuations being taken down. This was once a $1 billion company, and in the venture capital circles, they would refer to that as a unicorn. But now they're trading at around half that valuation level. And this isn't the first time we've seen IPO valuations being taken down, is it, Ted?
No, absolutely not. In fact, last year was basically, that was the theme of the IPO market last year, wasn't it? I mean, basically, we had Uber, Lyft, everybody was so excited about them. Then we had WeWork. WeWork was a train smash that didn't even get launched. Uber and Lyft, looking at their figures today, are down, pretty significantly. Got a spreadsheet over here. Uber is down 10% from its launch price. Lyft is down 30%. So, yes, I think there's a big question mark over not the IPO concept. I think that's important to bear in mind, that IPOs are a good thing. The problem is, how are they being handled? How are they being treated? And I feel like the IPO scenario that we faced for the last couple of years has really been almost like pump and dump. Pump and dump being a stock market technique when people talk up a stock to raise its price and then sell it to make money. And these are companies, before they get to the stock market, are being pumped really heavily through hype. And that was working up till really, I think, Uber and Lyft last year turned the corner. And now what we're seeing is investors are looking at the books, they're looking at the profits, looking at the numbers, they're looking at what companies can actually do, not what they say they can do. And I think that's the big difference that we've seen in the last 12 months or so.
So let's talk about that for just a second. So you talk about sort of the hype cycle that goes into a lot of these stocks that are prepping to IPO. And part of that hype story is the promise of profits. There's the promise of profits down the road, but the reality is when these companies are IPOing, so many of them are still operating at a loss. And I recall seeing a Goldman Sachs study from late last year. They said the proportion of companies that are IPOing and operating at a loss is the highest since the tech bubble. So, when we talk about the tech bubble, we talk about bubble valuations. People don't care about losses, but now all of a sudden it seems like it matters.
Well, yeah, and I think, losses, in a growth company, a company that has a business plan that gets you to break even and then into profit, being in growth mode is not a bad thing. We've invested in companies like that in our portfolios, particularly in the software sector. But the big question is, a lot of these companies are not in the tech sector. The tech sector lends itself to that growth model. The biggest example, the most famous example, is Amazon, a company that led with losses for years until it got to the point where it was actually dominating its sector, its e-commerce sector online. And as a result, it started to be able to capture market share from others, and then it started making big profits. And that's why people say, well, we're the Amazon of this, we're the Amazon of that. The problem is that a lot of things aren't amenable to that. And the biggest one, I think, is when you start talking about physical goods and services. Uber, Lyft, I think Casper is a good case in point. Peloton is a good case in point. You talk about companies that are in growth mode as though they're tech companies that have low marginal costs. In other words, they could just expand with no cost. That's not true when you're talking about physical goods and services. And I think what's happened is that a lot of investors, particularly on Wall Street, are looking at these companies that make physical things and claim that they're going to be able to dominate these markets and make a killing, and saying, hey, hang on, really anybody can do what you're doing. Why won't they? How are you going to preserve your profits? So yes, I think there's been a backlash, but the backlash has been against companies that pretend to be something that they're not, i.e. tech companies when they aren't really.
Okay, so then I guess my next thought then goes to, you mentioned Amazon and how long Amazon operated at a loss before, really starting to monetize their markets. I guess what is the right time? When is the right time to get into these names? Because I see the same thing with Uber in the headlines. I saw they're up big today because they're talking about maybe becoming profitable sooner than expected, but that comes on the heels of their fourth quarter report in which they posted a $1.1 billion loss. So what should investors do? Should they just avoid the IPO market, this corner of the market altogether, and wait for these companies to have more background behind them, or are there opportunities today that they can uncover?
Well, I think that the key thing is there's no one size fits all. And you mentioned companies that continue to talk a big game, even though they're still struggling with earnings and not making profit. The hype cycle doesn't end when a company IPOs. I mean, we've seen it with Tesla. I think people are starting to look at this recent bump in Tesla's price and realizing that it was probably the result of a very carefully orchestrated spin that the company put on their 2 quarters of profitability at the end of 2019 and bumped the stock price up, but that doesn't necessarily translate into a permanent reward to the company from the market. Same thing goes for Uber. I mean, how many times does Uber said profitability is right around the corner? A lot of times. So, for me, look, I'm an economist. I look at unit economics. I want to know, can you make a positive return on your investment for every unit sold? And if you can't do that yet, then you have to show me how you're going to do it. And if how you're going to do it is by just basically talking up your brand and somehow eliminating competition where, there's no clear way how you're going to do that, then I don't believe you. And so I would be hesitant to invest in these companies as a long-term play. Having said that, there's plenty of opportunity to play IPOs and companies like these from an options perspective, calls and puts, depending on what's going on. You can buy into them at the beginning of a run like the one we saw with Tesla, and then if you're lucky and you get out at the right point, you make money. But the key thing is that IPOs are not limited to the big names that you see in the press. There are lots of sectors that are doing well in the IPO market. And in fact, I called up some stats. We talked about it this morning. The average gain for the companies that IPO'd in the last 12 months was about 78%. Now, that includes all the Teslas, Ubers, Pelotons, all the SmileDirects, all those companies. But the big gains actually came in sectors where a lot of people don't even realize it's happening. The big one I'm calling up here on my spreadsheet is the healthcare sector. The average gain for the healthcare sector was 57% from launch to current price. Now, what that tells you is that the IPO game is not about headlines. It's not about waking up in the morning and seeing Good Morning America talking about Tesla and thinking, well, that's why I'm going to buy Tesla. You need to do your homework. You need to listen to what people like us who research this stuff all day are saying, because that's where the opportunities are. I mean, if you want to make good money in IPOs, you can. But the thing is, the hype companies are not the way to do it. That really just goes down to why we do what we do. I think is that the reason why we do our newsletters is because we try to cut through that. And I can tell you right now that there are numerous sectors where, looking at my figures, strong gains in healthcare, one in consumer goods, all kinds of companies that are IPOing under the radar. That's where the money is.
It's interesting you bring that, because I've had this debate with you so many times now. You talk about your economics hat, and it all comes down to unit costs. I'm surprised to hear you say, within this IPO market, with everything I've seen in the headlines, that there are opportunities when you start to look under the hood. Are there any other? I know you rattled off the healthcare sector. Has there been anything else to you that stands out?
Well, absolutely. I mean, let's look at a case in point. The company with the highest return in the consumer goods sector over the last 12 months from IPO to date in the consumer goods sector is a company called LMP Automotive Holdings. I'm not even sure what they do, but they're up almost 400%. since they launched. Now, they're at a very low price. Their share price right now at about $25 a share. They launched at $5. But somebody made a lot of money by buying that company, and nobody was talking about that company that I'm aware of, or very few people were. And I think that's the thing, is that whether you make money on a relatively unknown $5 stock that becomes a $25 stock, or a massively hyped company like Casper that launches at 12, and goes to whatever it's going to go to, it's still money, right? And the thing is, you're more likely to make the money on the company that people aren't hyping, the ones that are actually, the run-of-the-mill proper companies that are making stuff or delivering services that people want and that have a pathway to profit. And so, yeah, IPOs are the way to go. It's just a question of digging through the hype.
Okay. Yeah, so I know from the headlines, the IPO market can be a scary place at times, but as you demonstrated and showed us with sort of the proof, once you start to look underneath the hood, you can discover those opportunities that are out there. I know there's ETFs that track the IPO market as well. One of them is a First Trust IPO ETF. I believe the ticker on that is FPX. Holds about 100 names or so. It'll hold IPOs up to about 4 years after their IPO date. So giving a pretty broad exposure there. But if you want to get into the details, I mean, Ted, that's what you and I are doing on a daily basis. We're looking beyond the headlines. We're going underneath the hood to try to uncover those opportunities that no one is talking about, because that's where the big gains can be made, as you just showed us.
Yeah, I agree entirely. I think that the big sustainable gains come from the ones under the hood. I mean, as I said earlier, you can make gains on the story stocks, the speculative stocks. But remember that when you do that, you're speculating. You're basically betting that other people are feeling positive about a name or a story about a company like a Tesla or an Uber or a Lyft. And if they feel positive about it, they'll drive up the share price. If that's your game, you could ignore profitability, right? Because that means you're basically looking to make money off of speculative price movements. But that's not a game for long-term investors. That's a game for people who are going to wake up every day, look at those stocks, and see what's happening, and enter and exit frequently in order to capture profits. That's not what we do at the Bauman Letter. We're about investing in companies that are going to deliver long-term profits and therefore long-term share price increases. So we're about investment. We're not about speculation. And I think that's the critical difference.
Very good. I think we'll wrap up here on that comment. This is Clint Lee and Ted Bauman for the Bauman Letter. Thank you for joining us today on this edition of Your Money Matters.